Okay, let's just start assignment one, or you can say the test one, whatever you say. So number one is, which of the following statements in relation to the term dilution? Dilution means reduction. Reduce, that is dilution, meaning of the dilution. Are true or false? As per IAS 33, a reduction in earning per share is an example of dilution. That is true. Obviously, if earning per share is reduced, so obviously that is an example of dilution. A reduction in loss per share, an example of dilution, false. Now listen and listen carefully. Reduction in earnings is the dilution, but if there's a reduction in the loss, it is anti-dilution. So why statement 2 is false? Actually, statement 2 is referring to anti-diluted EPS. Because if loss per share is reduced, so it's a positive sign for the business. It's a positive sign for the business. Both the statements are false. No, the one is true, the second is false. Statement 1 is true and statement 2 is false. Charlie. Which two of the following items must be disclosed as per IAS 33? Now listen, if you come across any multiple choice question where directly you don't know the answer, then there's another way of answering such question is that is choice elimination. For example, they are saying in part in A, forecast earning per share for the following financial year. I think in any lecture, I did not mention anything like that in any of my lectures. That forecast earning for the next year, no, there's no such thing. A 5-year trend, we did not discuss anything like that. The weighted average number of ordinary shares used to calculate earning per shares, yes, you have to disclose this. Which two of the item must be, obviously you have to disclose the weighted average number of ordinary shares. Can I say without disclosing weighted average number of ordinary shares, then users of the financial statement, they will have no idea how did you calculate the EPS. So you have to give the disclosure of weighted average ordinary shares. Then we have earnings figures used in calculating basic and diluted EPS. Yes. So basically you have to give the disclosures of the earning figures as well as weighted average shares. Which of the following statement are true or false according to IAS 33? Earnings per share amount should not be presented if they are negative, that is loss per share, false. Every business is not a profitable business, or every company will not be making the profit every year. There's a possibility that in some time, instead of profit, you are having loss. So if instead of profit, you are having loss, so you will not be having earning per share, you will be having a loss per share. Even the loss per share comes, you have to disclose. So saying this, that since loss per share is a negative value, we should not disclose. According to IAS 33, we should not present this. That is a false statement. If there is a loss in the business, simply you will be writing loss per share. Earnings per share amount calculated for discontinued operations should be presented true. We have discussed, we have seen questions as well. Obviously, you have to calculate EPS for continued as well as discontinued operations. So both the statement are false. No. Statement 1 is false. Statement 2 is true. So beta is the answer. Okay, now. Parisa Limited issued new ordinary shares for cash at full market price. Also made 1 for 8 bonus issue. Now just let me tell you one. For example, we have shares issued. 100,000. 1124. Second, assuming 20% bonus issue. in March. And let's assume nothing else is there. Only there are two transactions. One is shares issued 1/1/24, 1 lakh, then 20% bonus in March. How we are going to calculate weighted average shares? Very simple date. Let's take the shares. Time factor. Adjustment factor. Weighted average. So shares issued we have 100,000. March 24. Bonus issue 20%. If I take 20% of 1 lakh, it is 20,000. Okay. So we will have 1 lakh 20. After March, let's say there is no transaction till December. Since bonus is 20%, so can I say the adjustment factor, bonus factor is going to be 1.2. And this BF is applicable only on those shares that are before the bonus. Can I say before bonus, we have 100,000 shares. So adjustment factor is applicable only on 1 lakh. Time factor from 1st January till March, we have 3 months. From March till December, we have 9 months. Let me just use the calculator. 100,000, 1.2 divided by 12. I'm getting 30,000. Here I'm getting 90. So your weighted average shares are 1 lakh 20. Now try to understand. We have properly time apportioned the bonus. We took the adjustment factor, each and everything. Or someone can do this, or directly. Your opening shares are 100,000. Just add the 20% bonus, which is 20,000. And no need to do any time apportionment, nothing, you will get the same result. Obviously, when you will be solving in the exam, you have to time apportion everything. I just want to explain one thing. In case of bonus issue, logically, since the bonus are issued in free, company is not getting any, company is not getting paid against the bonus because they are free. So according to IAS 33, then time apportionment for the bonus, it is not necessary. You can see that without the time factor, we are getting the same result, 1 lakh 20,000, and with the time factor, we are still getting a 1 lakh 20,000. So the concept is, it is not necessary that in case of bonus, you have to time apportion, okay? But when you people will be solving the question, please, you have to time apportion, because this is how we have discussed all the IAS 33. But if it comes in theoretically, if it comes in multiple choice questions, an examiner is asking you, is it necessary to time apportion in case of bonus? The answer is no, it's not necessary. And only in case of bonus, it is not necessary. Otherwise, if there is a cash issue, anything else, you have to time apportion. You have to time apportion. Okay. Are the following statements true or false according to IAS 33? New shares issued as a result of bonus should be time apportioned from their date of issue. Can I say false? New shares issued for cash at full market price should be time apportioned. Yes. Except the bonus, all other transactions are need to be time apportioned except the bonus. So both the statements are false. No, statement 1 is false and 2 is true. Okay, what are they asking? Simply they're asking basic EPS. Sama Limited is a company listed on Pakistan Stock Exchange. Given below is an extract from the statement of comprehensive income for the year ended December X7. We have profit before tax, and this is profit after tax. Sama Limited paid during their an ordinary dividend 4 lakh. Now listen, please. When we calculate EPS, dividend to ordinary shareholders, it has no link with EPS. Because while calculating EPS, we only deduct dividend to preference shareholders. Repeat, dividend payment to ordinary shareholders is not deductible. It has nothing to do with the EPS. We only deduct dividend on preference shares. So SL paid during their ordinary dividend 4 lakh, no link with IAS 33, and dividend on redeemable preference shares 5 lakh. Students, we have already discussed, logically redeemable preference shares, they are your financial liabilities. It is loan. Can I say logically on loan, we don't pay dividend, we pay interest. Repeat, on loan, we don't pay dividend, we pay interest. And obviously interest is already deducted before reaching at profit after tax value. So simply redeemable preference shares, they are loan, and on loan we don't pay even the examiner is writing dividend. The term dividend over here does not mean dividend, it is actually an interest. An examiner says these have been correctly accounted for in the financial statement, so there's no need to do anything. SL ordinary share capital is 2 million, par value is 10. And this authorized share capital has no link with EPS. Authorized share capital means this is the maximum share capital which company can, raise. Company can issue the shares and raise the amount. So right now their ordinary share capital is 2 million, par value is 10. It means 2 million divided by 10. We are having weighted average shares 2 lakh. So simply profit after tax is 4.2 million. So very easily basic EPS comes. $21. What figure for X7 earning per share will be shown as comparative information in the financial statements? Let's see. Shaista Limited is a company listed on Pakistan Stock Exchange. Its financial statement for the year ended December X7 showed EPS. Last year, the EPS is 8.45. Okay. In the current year, they made a bonus 143. So BF is, how do we calculate bonus adjustment factor? Shares after bonus divided by shares before bonus. Shares after bonus divided by shares before bonus. So your BF, whoever is having 3 shares will get 1 bonus. So after bonus, there will be 4 shares, before it is 3. How do we restate comparative EPS, previous year EPS? All you need is just multiply the previous year EPS with the inverse of this BF. So here comes the restated EPS. 8.5, 3 upon 4. So 8.5, 3 by 4. I'm getting 6.375. So obviously it is Charlie. Simba Limited is a listed company at December X7. It had ordinary share capital rupees 2 million. Profit before tax is 5 lakh, tax is 125. Now listen. Profit before tax is 5 lakh. They have given us the tax 1,25,000. So profit after tax is 3,75,000. We have just 2 million share capital. The par value is 10. So weighted average shares are 200,000. Here comes your basic EPS. 3,75,000 divided by 200,000. I'm getting 1.875 or with a little bit rounding of 1.88. Okay. They are asking what is ML basic EPS. Muntaha Limited is a listed on Pakistan Stock Exchange. During their December X7, the company had 5 million ordinary shares, rupees 1 each, 500,000, 6% irredeemable preference shares. Irredeemable preference shares, they are equity. Par value is 10. The profit after tax is 6 million. We need to calculate basic EPS. Look at this. Profit after tax minus preference dividend. Divided by weighted average ordinary shares. Profit after tax, they have given us 6 million. How many shares are there? 5 million. If organization is just having 5 million shares, no other information, nothing else, it means all 5 million are weighted average shares. You have to deduct the preference dividend. How do we calculate preference dividend? Basically, we need a preference share capital multiplied by the percentage. How do we calculate preference share capital? Actually, if you have been given number of shares and the par value, just multiply them. You will get preference share capital. 5 lakh, they are 6% irredeemable preference shares. The par value is 10. Now listen. 500,000 multiply by 10. It will give you preference share capital. 500,000 multiply by 10. It gives us preference share capital. Multiply by 6%. It will give you the preference dividend. 300,000. Basically, 500,000, their number of shares, 10 is a par value, so the preference share capital comes 5 million. 6% of 5 million is 3 lakh. So minus 3 lakh. Let's see what are we getting. 1.14. Okay. Student, please, can you quickly attempt question number 19? I really want you, please attempt this question number 19. Okay, now let's try together. Mansha Limited had 1 lakh equity shares issued on 1st January X7. On 1st July X7, it issued 20,000 new shares by way of 1 for 5 bonus issue. On 1st October, it issued 28,000 new shares for cash at full market price. Date, number of shares, time factor, adjustment factor, weighted average. 11x7. How many shares? 1 lakh. Okay. Then 1st July, there's a bonus issue of 1 for 5. If bonus is 1 for 5, then BF is 6/5. Whoever is having 5 shares, against 5 shares, company has made 1 bonus. So obviously, after bonus, 5 shares, they will become 6. And how do we calculate bonus adjustment factor? Simply shares after bonus divided by shares before bonus. Okay. First July. There's a bonus issue of 20,000. It means on 1st July, the total shares are 120. BF is only applicable on those shares they are before bonus. Before bonus, we have 1 lakh shares. And the BF is 6 upon 5. Time factor from 1st January till 1st July, we have 6 months. On 1st October, what happened? They have issued new shares. 1st October. Shares issued. 28,000. Okay. From 1st July till 1st October, we have 3 months. Then from 1st October till December, we have 3 months. Let's use the calculator. We have 60,000 here. 30,000. 1,48,000, 3 by 12. 37,000. So weighted average shares are 1,27,000. Which of the following need not be adjusted in profit after tax for calculating basic EPS? Very important point. Actually, something which is already adjusted, you're not going to adjust it again. Repeat, if something is already adjusted, then there is no need of making any adjustment. So which of the following need not be adjusted? Redeemable preference shares dividend. Very important point. Can I say redeemable preference shares? Dividend means this is actually an interest. Why? Because redeemable preference share is they are loan. And we have already discussed on loan, we don't pay dividend. On loan, actually, we pay interest. Now listen. Can I say interest is already adjusted in your profit? So there's no need for the further adjustment. The second is irredeemable preference share dividend. Yes, while calculating EPS, you have to adjust dividend of irredeemable preference shares like we did in the previous question. This one. We deducted dividend on irredeemable preference shares. So point number 2 needs adjustment. Basically, ordinary final dividend, ordinary interim, ordinary dividend has no link with EPS. So logically, the answer is A. Why A is the answer? Because it is already adjusted. So something which is already adjusted, so there's no need for the further adjustment. So students, finally, we have completed your IAS 33. I tried my best to give you a really good comprehensive practice, each and everything assignment as well. Now let's have a quick revision of IAS 33. After each IAS, we'll be doing a quick revision of the main concepts, okay? That quick revision will really help you, especially near to the exams for revising the entire IAS. So let's see. Number 1, obviously the formula of earning per share, profit after tax, minus preference dividend. We have not seen NCI non-controlling interest. It's better to just know the concept. Divided by weighted average shares. Weighted average ordinary shares. Preference shares There are two types of preference shares. Redeemable preference shares and irredeemable preference shares. Now let's start from it. IAS 33. Earning per share. The first thing is, if we are evaluating the performance of any business, then obviously earning per share is one of the key, I would say, indicator which shows the profitability of the business. If there's a rising trend in earning per share, that is a more reliable indicator of the performance as compared to rising trend in the profitability. So earning per share is you can say, the key performance indicator of a business. Okay. How do we calculate earning per share? Profit after tax minus preference dividend minus non-controlling interest. Non-controlling interest will only be deducted. Non-controlling interest will only be deducted when you are calculating EPS for the group. So if you are calculating EPS for the group, then non-controlling interest will be deducted, divided by weighted average ordinary shares. When we say weighted average, so now you know that while calculating weighted average, you have to consider the time factor, adjustment factors. So it is weighted average. It's not a simple average. Now let's talk about preference dividend. Obviously, preference dividend is given to the preference shareholders. Repeat, to whom we are going to provide preference dividend? Obviously, to the preference shareholders. We have two types of preference shares, redeemable and irredeemable. A very important concept is, logically, the redeemable preference shares, they are loan. The technical name is, it is a financial liability, and you will study this, don't worry at all. So redeemable preference shares, they are loan, they are financial liabilities. On loan, we don't pay dividend, we pay interest. Even your examiner says we have given dividend to the redeemable preference shares, we will not accept that term dividend as dividend. We will say, even though you have written dividend, it is actually, in essence, it is an interest. Because on redeemable, we pay interest, we don't pay dividend. Okay. So it means while calculating EPS, preference dividend has no link with the redeemable preference shares. Now we are left with irredeemable. Logically, irredeemable preference shares, they are equity. Irredeemable preference shares, they are equity, and actually dividend is paid to the equity holders. So it means the dividend which we are deducting from profit after tax, it actually relates to irredeemable preference shares. Now we have two types of irredeemable preference shares. One is cumulative, another is non-cumulative. If your examiner has just written irredeemable preference shares, nothing is mentioned, we always assume given preference shares are cumulative. In case of cumulative, either dividend is declared or not, while calculating EPS, you will have to deduct the preference dividend. Repeat, in case of cumulative, either company has declared the dividend or not, irrespective of the dividend declaration, you have to deduct preference dividend while calculating EPS. The concept behind cumulative is, if organization, for example, in 2024, if company has not paid the dividend to the cumulative irredeemable preference shareholders, then in 2025, they will be providing the dividend of 2 years. That is why we say cumulative means unpaid period is countable. But the main concept which you need to know is, in case of cumulative preference shares, either dividend is declared or it is not declared, you will have to deduct preference dividend. Non-cumulative, in case if, number one, examiner categorically mentions in the question that given shares are irredeemable non-cumulative, if it is mentioned, only then we will accept they are non-cumulative, otherwise we will not accept they are non-cumulative. In case of non-cumulative, if the dividend is declared, only then while calculating EPS, we are going to deduct the preference dividend relating to the non-cumulative preference shareholders. Otherwise, we will not. Repeat. In case of non-cumulative, it has to be categorically mentioned in the question that company has declared the dividend. Only then we will be calculating the dividend on non-cumulative irredeemable preference shares. Otherwise, you will not calculate any preference dividend for non-cumulative irredeemable preference shareholders. And in case of non-cumulative preference shareholders, unpaid period is not countable. Whenever company pays, company is going to pay only a 1-year dividend. Unpaid period is not countable. So non-cumulative, logically unpaid period is not countable. But let me give you a very interesting example regarding non-cumulative. For example, 2024 company has not paid the dividend. Obviously, according to the concept of non-cumulative, if in 2025 company pays the dividend, they will be just paying the dividend of 2025. But a very interesting event happens in 2025. Company categorically mentions and company says that in 2025 we have decided to give preference dividend to the non-cumulative preference shareholders, and we are willing to give them the dividend of 2 years. It does normally it is not going to happen, but I'm just giving you something interested happened, and out of nowhere company has mentioned in 2025 we have decided to give the dividend of 2 years to the non-cumulative preference shareholders. It's okay. If it is categorically mentioned in the question that company has decided to give 2 years dividend to the non-cumulative preference shareholders, in that case, while calculating EPS, I'm going to deduct the dividend of 2 years. Why? Because in non-cumulative, if the dividend is declared, only then I'm going to deduct while calculating EPS. Otherwise, we will not deduct the dividend for the non-cumulative preference shareholders. And if examiner has written so clearly that in 2025, we have decided to give 2 years dividend to the non-cumulative preference shareholders, then okay, I have no issue at all. While calculating EPS, I'm going to deduct the 2 years dividend, but it has to be mentioned categorically only then. Otherwise, if you ask me cumulative, in case of cumulative, even the examiner says we have decided to give 4 years dividend together, still I'll be deducting 1 year dividend. Why? Because in case of cumulative, when company was not declaring the dividend, still I was deducting a 1 year dividend. Because the cumulative concept says, irrespective company has declared the dividend or not, irrespective of that, you have to calculate the preference dividend and minus it. So this is few interesting examples, I would say. Now, when we say weighted average ordinary shares, actually, how do we calculate? Obviously, the first column is date. Another column is number of shares. Then we go for time factor. Adjustment factor, and finally, weighted average. So these are the 5 columns we use for calculating weighted average ordinary shares. In case of bonus issue, you should be able to calculate BF, bonus factor. How do we calculate bonus factors? Shares after bonus divided by shares before bonus. So shares after bonus divided by shares before bonus. Okay. And this bonus factor is applicable only on those shares that are there before the bonus. This bonus factor is only applicable on those shares they're there before the bonus. Okay, right issue. We know that right issue is made to the existing shareholders. In right issue, there is an incentive for the existing shareholders. Right issue will be at a lower price as compared to the market value. And always remember one thing, whenever you have been given two dates, one is announcement date, another is entitlement date, then you have to calculate each and everything by using entitlement date. Entitlement date is more important than the announcement date. Obviously, when nothing is mentioned, whatever, then single date is given, then the single date is your announcement as well as entitlement date. But whenever your examiner gives you two dates separately, one is announcement date, another is entitlement date, then obviously you have to do the calculation according to the entitlement date. Okay, in case of right issue, you should be able to calculate number one, theoretical X right price. You should be able to calculate theoretical X right price. Actually, theoretical X right price means share price after right issue. Share price after right issue. Theoretical X right price means share price after right issue. Then in case of right issue, the second point you should be able to calculate, that is adjustment factor. How do we calculate adjustment factor? Share price before right. Divided by share price after right, and the name of the share price after right is TRP, theoretical X right price, and this adjustment factor is applied only on those shares they are before right. Adjustment factor is applicable only on those shares they are before right. Adjustment factor is only applicable on those shares they are before right. Okay. Another thing is, whenever there is a restated EPS, restated EPS, whenever there is a bonus issue in the current year, bonus issue. If there is a bonus issue in the current year, you have to restate the previous year EPS. How do we restate the previous year EPS? Just do one thing. Take previous year EPS and multiply that with the inverse of bonus factor. If you also have a right issue, again, you need to restate the previous year EPS. So actually, either you have both the events or a single event, you need to restate previous year EPS. How do we restate the previous year EPS? Take the previous year EPS and simply multiply with the inverse of, in case of bonus, that is inverse of bonus fraction. In case of right issue, inverse of adjustment factor. You have to restate the previous year EPS. Either in the current year there's bonus or there's a right issue. And a very important concept is, either in the current year you have bonus or right, or even both, you have to restate the previous year EPS. There are two other events as well in which we do restate the previous year EPS, but that is not in our syllabus. One is share split, another is share consolidation. But these both events are not in FR. That is why we are not discussing them. Now, last few concepts. Potential ordinary shares. Actually, potential ordinary shares means the instrument which is not the ordinary share in day one, but there's a possibility it is going to become ordinary share in the future. Examples of potential ordinary shares are share options, convertible bonds, convertible preference shares. So potential ordinary shares means they are in day one, they are not ordinary shares, but they have the potential to become ordinary. So basically, why there's a need to study the concept of potential ordinary shares? Examples of potential ordinary shares are share options, convertible bonds, convertible preference shares. So share options, convertible bonds, convertible preference shares, they are just examples of potential ordinary shares. Basically, while calculating diluted EPS, while calculating diluted EPS, we assume that while calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary in day one. An objective of diluted EPS is to show the dark side of the business. So you need to know that diluted EPS is an assumption-based value, and while calculating diluted EPS, we assume that all the potential ordinary shares, they have become ordinary in day one. So whatever EPS you are going to calculate, that is going to be your diluted EPS. Another important point, if in the entire question there is only one potential ordinary shares, then you can simply calculate the diluted EPS in a very simple way. But if in the question you have been given more than one potential ordinary shares, then we calculate diluted EPS by using statements. Now let me give you a very important concept. What is that? Basically, let me change the color. Okay. Basically, when we say restated EPS, so whenever there's a bonus, there's a right, and I said there are two more events, but they are not in the syllabus. You have to restate the previous year EPS. Now the question is, do I need to restate basic EPS only, or do we need to restate the diluted EPS as well? Now listen. If in the question you have been given a previous year basic as well as diluted EPS, so always remember that you need to restate previous year basic as well as diluted EPS. Repeat. If in the question examiner gives you basic as well as diluted EPS of the previous year, and in the current year they are a bonus issue, right issue, any one of them, both of them, so you have to restate not only previous year basic EPS, you have to restate the previous year diluted EPS as well. But how do we restate the previous year diluted EPS? That is very important. Let me give you an example quickly. Assuming this is 2024, we are having a profit after tax 500,000. Let's say weighted average shares we have 250,000. Okay. In 2024, we have share options 50,000. Average market value is $100. Exercise price is $40. So we have profit after tax 5 lakh, weighted average shares 2,50,000, share options 50,000, average market value is 100, exercise price is 40. Now, 2024 required. We need to calculate basic and diluted EPS. Okay, no issue at all. Very easily we can calculate basic EPS. Profit after tax is 5 lakh. Weighted average shares we have 2,50,000. So obviously the basic EPS is 2. Now, can I say in case of share options, actually we need to calculate share for nil consideration. In case of share options, we need to calculate shares for nil consideration. Can you quickly calculate the shares for nil consideration, please? Basic EPS we have 2, okay? Now let's see shares for nil consideration. We have 50,000 share options. Look at this. Exercise price is 40. Average market value is 100. How much we are not charging? We are not charging 60. Okay. Out of 100. So we have shares for nil consideration 30,000. We have shares for nil consideration 30,000. Now let's calculate diluted EPS. Profit after tax is 500,000. Obviously, potential ordinary shares for nil consideration, they will be added to the ordinary shares. Let's see what are we getting. 500,000 divided by 280. I'm getting 1.7857 diluted EPS. 1.7857. Okay. Now listen. 2025, okay? Assuming in 2025, just there is bonus issue, assuming it is 20%. And requirement is calculate basic and diluted EPS. Restated basic and diluted EPS, which restated. There's no other information, just this is the information. Calculate restated basic and diluted EPS. Calculate restated basic and diluted EPS. Okay, calculate restated basic and diluted EPS. How will you calculate? Look at this. 2025, your bonus fraction is 1.2. Let's calculate restated basic EPS. Restated How do we restate? Just take the previous year basic EPS, multiply with the inverse of the bonus fraction. Basic EPS is 2. So it means I'm getting 1.667. No, very important point. Look at this. The same thing can also be calculated like that. Restated basic EPS. Profit after tax is 500,000. When we calculated basic EPS 2, we used ordinary shares 2,50,000. Obviously, 5 lakh divided by 250 gives you basic EPS 2. Another way to calculate the restated EPS, someone can do this also. 2,50,000 multiplied by 1.2. Obviously, you're getting the same result, which is 1.667. I hope this is clear. Actually, multiply this with 1/2 means you are doing 1/1.2. So 2,50,000 into 1.2, I'm getting the same result. So what is the why we are discussing this when we already have the answer? There's a reason. Let me tell you what is the reason. Restated diluted EPS. Restated diluted EPS. How do we calculate restated diluted EPS? Previous year EPS, we have 1 point, diluted EPS of the previous year is 1.7857. And bonus fraction is 1.2. So 1.7857 divided by 1.2. I'm getting 1.488. And this, what I'm saying, it is incorrect. Why it is incorrect? Why it is incorrect? This is a big question. Now try to understand. Why it is incorrect, let me show you. Restated EPS. Restated diluted EPS. Actually, we have 500,000 profit after tax while calculating diluted EPS. The denominator, in the denominator, we had total 2,80,000 shares. Am I right? Total number of shares are 280. Now try to understand. If you write 280, multiply this with 1.2, so obviously you will get 1.488. And again, I'm saying this is incorrect. Why it is incorrect? Let's go for the correct answer now. Restated profit after tax is 500,000. The breakup of 280 is 2,50,000 and 30,000. Actually, 2,50,000, they are actual ordinary shares. 30,000, they are not actual ordinary shares. They're just, while calculating 30,000, we have assumed that if the potential ordinary share, which are the share option in our example, if they become ordinary in day one, then what happens? But can I say actually 30,000 shares are not issued? Actually, 30,000 shares are not issued. They are you getting this point? Actually, bonus fraction is applicable only on those shares. They do exist before the bonus. So logically, 30,000, they're just potential. You have made an assumption. And through assumption, you have taken this 30,000. So, but practically, 30,000, they don't exist. So logically, the bonus fraction is actually only applicable on those shares they are there before the bonus. So can I say they are only 2,50,000 shares? 30,000, they are not there. It's just an assumption-based value. So look at this. While restating the diluted EPS, what I'm writing, take 2,50,000, 1.2 and plus 30. Make sure that you should not be taking bonus fraction effect on the potential ordinary shares while calculating diluted EPS. Why? Because you have actually not issued these shares. That is why the above two calculations were incorrect. So it's a very, very, I would say, important concept which I've just given you. If you come across a question where you need to restate the diluted EPS, so make sure bonus fraction effect should not be given to the potential ordinary shares. So I'm getting the answer 1.515. This is how we restate the diluted EPS. This is how we restate the diluted EPS. Okay. Now, one more thing. What is that? For example, 1/1/2024, we have shares issued 1 lakh. Shares issued 150. In March. Shares issued 1 lakh in September. Year end is December 2024. 31st January 2025. Bonus issue is 20%. Requirement. You need to calculate weighted average ordinary shares. Weighted average ordinary shares, and you are working for 2024. You just need to calculate weighted average ordinary shares. So student, please try. Let's try together. Make columns, date, number of shares, Time factor. Adjustment factor. Obviously weighted average. 1/1/24 shares issued. We have 100,000 shares in January. Then in March, 1,50,000 shares were issued. Total becomes 2,50,000. From 1st January till March, time factor is 3 months. From 1st January till March, the time factor is 3 months. After March, in September, they issued 1 lakh shares. Okay, now from March till September, can I say we have 6 months? After this 1 lakh shares, the total number of shares will become 3,50,000. After 30th September, no issue. So from 30th September till 31st December, we have 3 months. So first 3 months, company is having 1 lakh shares. Then next, I would say from March till September, company is having 2,50,000 shares. From September till December, company is having 350 shares. Now, very important concept is, look at this. Let me change the colors here. There's a bonus issue of 20%, and this is issued after the year end of December 2024. It is issued on 31st January 2025. Now listen. According to IAS 10, obviously, which we are going to study, don't worry at all. IAS 10, events after the reporting period. Events after the reporting period. Basically, there are two types of events. One is adjusting event and another is non-adjusting event. You will study this in detail, don't worry at all. According to IAS 10, if there's a bonus issue after the reporting date, if there's a bonus issue after the reporting date and before the authorization of financial statements, normally it takes 3 months to authorize the books. Basically, normally it takes 3 months that audit will be completed, your books will be ready to go to the stock exchange. So according to IAS 10, if there is a bonus issue after the reporting date, before the authorization of financial statements, then that bonus issue is an adjusting event. So you have to adjust the previous year weighted average ordinary shares. Even though the bonus 20% is issued on 31st January 2025, but since it is issued before the authorization of financial statements, and I have given you the idea, normally it takes 3 months to authorize the books. So according to IAS 10, bonus issue is an adjusting event. So you have to adjust the previous year weighted average ordinary shares. So 20% is the bonus issue. So BF is 1.2. And this 1.2 BF is applicable on all those shares they are before bonus. And let me repeat, according to IAS 10, if there's a bonus issue after the reporting date, before the authorization of financial statement, so it is an adjusting event. So you have to adjust the previous year weighted average ordinary shares. How you are going to adjust? All those shares, they are before bonus, adjustment factor is applicable on them. So 1.2 is coming here, as well as here, as well as here. So let me repeat, if there's a bonus after the reporting date, before the authorization of financial statement, and which takes normally 3 months, books to be authorized. So you have to take that bonus issue as an adjusting factor, adjusting event. So 1 lakh multiplied by 3 divided by 12 into 1.2. I'm getting 30,000. 2 lakh 50. 1,50,000, the answer is here. Three lakh 50, 3 by 12, 1.2. 1,05,000. Can you please simply add all of them? What are we getting? The result. Let's see the total. What is the total? 2,85,000. So 30 plus 150 plus 105, 285. So students, I would say congratulations. We have completed IAS 33 with all the aspects. Each and everything, practice, concepts. Even in the last class, you can see that we have revised and we did discuss something new as well. So that is all for IAS 33 and today's class. So that is the completion of IAS 33. I'll be conducting a class tomorrow. Okay, timings I'll mention. But it will be somewhere in the night. My timing is going to be around 9:45 in the night. So it is going to suit you. Don't worry at all. So we'll be having a class tomorrow with a new IAS. Okay. I really want all of you keep practicing IAS 33 so that when you are studying the new IAS, you should not forget the previous IAS. So thank you very, very much. See you all inshallah in the next class. Have a nice day.